The screen looks simple. So, numbers moving. A list of names you recognize from buildings and billboards and the apps on your phone. But the simplicity of the interface doesn't match the complexity of what you're actually doing, which is becoming an owner. A partial owner of something real, something that makes money, something that will still exist tomorrow and next year and a decade from now if the business holds. You deposit $500. Not a large amount. But it matters to you in a way that a $500 purchase at a store never did. Because this $500 isn't leaving. It's changing form. This is level 1. And it starts here, in the gap between how simple the screen looks and how long it takes to understand what you're actually participating in. Level 1. The beginner. You make your first investment not to trade it but to hold it. To see what the experience of ownership feels like over time. You start paying attention differently. Not just to prices, but to what the company actually does. How it makes money. Why people buy from it. Why it might grow or why it might not. You read earnings reports. You read analysis. You encounter two completely different types of people in the financial world. Those trying to predict the next short-term move and those trying to understand the long-term business. That difference becomes your first real decision. What kind of participant do you want to be? Your returns at this level are almost irrelevant. $500 growing to $530 over a year is not the point. The point is building the mental model. Understanding that markets move constantly, that prices fluctuate daily for reasons that have nothing to do with the long-term quality of a business, and that reacting to every movement is the behavior that produces the worst outcomes. The shift that moves you forward is not financial. It is psychological. You stop watching every tick. You start thinking in years. You go from learning to participating. And participating is the beginning of building. Level 2, the retail investor. You invest every month. Not when the market feels good. Not when prices are rising and the news is optimistic. Every month, $500 or $1,000 or whatever the budget allows. Automatically. Consistently. Regardless of what the market is doing. Your portfolio starts taking shape by design, not by accident. 60% equities. 20% ETFs across different sectors. 20% cash and short-term holdings. You understand what diversification actually means now, not just owning multiple things, but owning things that behave differently under the same conditions. When one part of the portfolio drops, another holds. When the market falls broadly, everything falls, but it falls in proportion to a structure you designed in advance. The market drops. Not 1% or 2%. Sometimes 10%. Sometimes more. And this is the first real test. You don't sell. You don't sell because you understand something that most people never learn until they've lost money learning it. Volatility is not risk. Selling at the wrong time is risk. The market going down is not the danger. Responding to it incorrectly is. You continue investing through the drop. Month after month. This is dollar cost averaging, not a complicated strategy, just the behavior of buying consistently regardless of price, which means buying more when prices are lower and less when they're higher. Over time, the average cost of your position improves simply by continuing. Your behavior is no longer random. It is structured. And structured behavior, applied consistently over years, is how the next level becomes possible. Level 3, the consistent investor. Your portfolio crosses $100,000. And that number changes something. A 1% move is no longer abstract. It's $1,000. A strong year in the market, 10%, 12%, adds $10,000 to $12,000 without a single additional contribution. For the first time, the returns feel real in a way they didn't before. The compounding that you understood intellectually now exists in your account as an actual number with actual weight. Your strategy becomes more defined. You set a target allocation, 70% equities, 20% fixed income, 10% cash or alternatives, and you maintain it. Not based on how you feel about the market, based on the framework. When equities grow too large as a percentage, you trim and rebalance. When they fall, you add. The discipline of rebalancing forces you to buy low and sell high structurally, without requiring you to predict anything. You begin thinking about risk differently. Not just how much can I make, but how much volatility am I taking on to achieve it? You look at drawdowns. You look at how different assets move in relation to each other. Correlation becomes a real concept, not a textbook term. Market corrections stop feeling like emergencies. They feel like part of the process. Because at $100,000, you've now lived through enough market movement to understand the pattern. Markets decline, markets recover, the recovery rewards the people who stayed. You also start paying attention to taxes. Holding assets longer than a year for long-term capital gains treatment. Using tax-advantaged accounts wherever possible. The tax decisions don't feel exciting. They are among the most impactful decisions you make at this level. The shift that moves you forward is this. Success is no longer about picking the right investment. It is about executing the same disciplined approach consistently over time, regardless of what the market is doing on any given day. Level 4, the advanced investor. Your portfolio crosses $250,000 and continues toward $1 million. And the focus shifts from building wealth to optimizing how it grows. At this scale, small percentage improvements produce significant absolute differences. A 2% improvement in annual returns is no longer a minor adjustment. It's an additional $5,000 to $20,000 per year, compounding forward. Every decision matters more because the numbers they're applied to are larger. You move beyond basic allocation and start refining the structure. You adjust exposure across asset classes based on time horizon and market conditions. Fixed income takes on a more deliberate role, not just as a placeholder but as a hedge against equity volatility. Real estate and alternative assets enter the portfolio as separate allocations with specific purposes. Tax efficiency becomes strategic. You place high-turnover investments in tax-advantaged accounts and hold long-term positions in taxable accounts to minimize the tax drag on growth. Tax loss harvesting, selling positions at a loss to offset gains elsewhere, becomes a tool you use intentionally, not accidentally. The question you ask about every investment changes. It is no longer, how much can this return? It becomes, what is the probability of a significant loss, how large could that loss be, and is the expected return sufficient to justify taking that risk? At this level, avoiding major losses becomes as important as generating gains. Because a 40% drawdown requires a 67% recovery just to break even. Capital preservation is not a conservative instinct. It is mathematical reality. The shift that moves you forward is the recognition that investing is now a system, not a series of individual decisions. And as capital grows, access begins to change. Level 5, the high net worth investor. Your investable assets cross $1 million. And the financial system begins to treat you differently. You are no longer limited to public markets. Private investments begin to appear, not because they were hidden before, but because your capital now qualifies you to access them. Private equity funds. Venture capital deals. Real estate syndications. Direct investments in private companies. These are not listed on any exchange. They are introduced through networks, advisors, and institutions. The structure is different. These investments require larger minimums, often $250,000 to $1 million per position. They require longer holding periods. Your capital may be committed for 5 to 10 years with returns distributed over time, not immediately available. Liquidity disappears. You cannot sell when you want. You wait for the investment to mature and distribute. In exchange, the potential returns can exceed what public markets offer. But so does the risk. You are evaluating opportunities based on deal structure, the quality of the operator or fund manager, projected internal rate of return, and what happens if the investment underperforms. You begin working with professionals, private bankers, tax specialists, estate attorneys. Not to replace your judgment, but to structure your portfolio in ways that are increasingly complex and increasingly consequential. A mistake at this level costs more than a mistake at level 2. The stakes are higher because the numbers are larger. Your portfolio is no longer one account with a few holdings. It is multiple allocations across multiple strategies, public equity for growth, private equity for long-term upside, fixed income for stability, real estate for income. Each allocation serves a different purpose. The portfolio as a whole is a structure, the shift that moves you forward. At this level, opportunities don't need to be found. They are presented. And the challenge is no longer access. It is selection. Level 6, the professional investor. Your capital crosses $10 million and investing stops being something you do alongside your life. It becomes your primary function. A 5% annual return is no longer a percentage. It is $500,000 to $5 million in actual dollars, gained or lost in a single year. Every allocation decision carries real weight. Every percentage point matters in ways that feel entirely different from the earlier levels. Your portfolio operates like a business. You may establish a family office, a formal structure for managing investments, taxes, reporting, and estate planning across a complex, multi-asset portfolio. You track internal rate of return across private investments. You benchmark performance against the S&P 500 and other indices. You evaluate whether every dollar of capital is being deployed as efficiently as it could be. Avoiding major losses becomes the primary discipline. Because at this scale, a significant drawdown, 30%, 40%, is not just uncomfortable. It is structurally damaging. The capital required to recover is enormous. The time required to recover is measured in years. Capital preservation is not a conservative choice. It is the foundation everything else is built on. Your identity shifts. You are no longer an individual investor managing a personal portfolio. You think and operate like a portfolio manager, with allocation frameworks, performance metrics, and decision processes that apply consistently across all conditions. And the decisions you make begin to have effects beyond your own account. Capital at this scale moves markets in small ways. The shift that moves you forward. Your decisions begin to influence where money flows. Not just for you. For others. Level 7. The institutional investor. You are now allocating hundreds of millions, sometimes billions, through a fund, a family office, or an institutional structure. You no longer focus on individual securities. You focus on allocation decisions. How much capital goes into public equity? How much into private markets? How much into credit strategies, real estate, hedge funds? You are not picking stocks. You are directing capital at scale. You invest through managers as much as you invest directly. You evaluate hedge funds, private equity firms, venture capital funds, not by their pitch decks but by their track records, their strategy consistency, their fee structures, and the alignment between their incentives and yours. Due diligence on a single fund allocation involves months of analysis and can involve committing hundreds of millions. Liquidity is a strategic dimension, not a preference. You cannot move capital quickly without affecting pricing. A large exit from a position can move the market. A large allocation can lift a company's valuation. Decisions are planned over quarters, sometimes years. The time horizon of institutional investing is fundamentally different from individual investing. Your capital begins to influence outcomes. When you commit to a sector, others follow. When you exit, it is noticed. You are part of a network of institutional allocators, fund managers, and advisors where information flows through relationships and trust built over years. At this level, investing is not about selecting assets. It is about directing capital at scale. And the capital is large enough that it no longer just participates in markets. It begins to shape them. Level 8. The billionaire investor. Your net worth crosses $1 billion. And scale changes everything about how the game is played. You are no longer thinking in portfolios. You are thinking in positions. A single investment is not a few million. It is hundreds of millions, sometimes billions, deployed into a single company, a single strategy, a single bet made with extraordinary conviction and extraordinary capital behind it. Your capital is large enough to take control, not just ownership. You participate in acquisitions. You take large equity stakes that come with board seats and strategic influence. You shape how companies operate, not just whether their stock goes up. Public markets are still relevant, but they are no longer your primary arena. Private markets dominate: direct deals, co-investments, large capital placements negotiated privately between you and the principals of a business. The terms are set in those private conversations, not by the exchange. Your decisions carry visible impact. When you take a position in a company, the market reacts. When you exit, the price moves. Entering or exiting requires coordination, timing, and patience because moving quickly would hurt the position itself. You move deliberately. Every step planned. Your network operates at a different altitude. Other large investors. Institutional leaders. The executives running companies that will define industries. Opportunities at this level are not found. They are created through relationships built over years with people operating at the same scale. And at this level, investing is no longer primarily about returns. It is about influence. Which companies get capital? Which industries expand? Which ideas get funded and which don't? Because at this scale, you are not reacting to the market. The market is reacting to you. 8 levels. The same activity, allocating capital to assets, producing completely different experiences, different tools, different psychology, and different consequences at every stage. The beginner is learning what ownership means. The retail investor is building the habit of consistency. The consistent investor is discovering compounding as a physical reality. The advanced investor is building a system rather than making individual decisions. The high net worth investor is navigating private markets and selection. The professional investor is running capital as a primary function. The institutional investor is directing capital at scale. The billionaire is shaping outcomes. Every level requires something the previous level didn't teach you. Every level changes what the game actually is. The question is not which level you're at. The question is whether you're building toward the next one.